Corporate finance and project finance are two distinct methods of financing business activities. Understanding the differences between them is important for businesses, lenders, and investors involved in financing transactions, particularly in determining the financing structure to utilize based on the financial need of the business and the purpose of the funding. My name is Ayoola Hassan. I'm a senior associate at Adeola Oyinlade Co. In this video, I will be speaking on the key differences between corporate finance and project finance. Corporate finance refers to financing raised by a company based on its overall financial strength and assets. The company is the borrower and remains responsible for repaying the debt regardless of the success or failure of any of its projects. As a result, lenders assess the company's cash flow, balance sheet, and creditworthiness when deciding whether to provide financing. Project finance is a financing structure where funds are raised for a specific project and repayment is primarily derived from the project's future cash flow. The project is usually undertaken through a special purpose vehicle which is legally separate from the sponsors. The key difference lies in the source of repayment and risk allocation. In corporate finance, the lenders rely on the company's financial strength and assets. However, in project finance, the lenders rely primarily on the project asset and future cash flow. In other words, corporate finance focuses on the company, while project finance focuses on the project. A special purpose vehicle is established to keep the project legally and financially separate from the sponsor's other businesses. Accordingly, the SPV owns the project asset, enters into contracts with the lenders, the off-takers, the construction contractors, and others. It also borrows financing from the lenders. Establishing a special purpose vehicle helps keep the project's risk separate and limits the sponsor's exposure if the project does not perform as expected. Yes, project finance transactions are generally more complex because they involve multiple stakeholders, extensive due diligence, sophisticated risk allocation mechanisms, regulatory approvals, and detailed contractual arrangements. On the other hand, corporate finance are generally straightforward because they focus primarily on the company's financial capacity. Project finance is commonly used for capital-intensive projects in sectors such as infrastructure, oil and gas, mining, real estate development, and telecommunication. These projects typically require substantial investment and have predictable long-term revenue streams. The appropriate choice between corporate finance and project finance largely depends on the nature of the transaction, the size of the project, the parties involved, and the risk profile.